Hey everyone, welcome back to another Explainer. Today we're tackling a massive topic that's been absolutely dominating the financial world, the recent crypto market correction. We're going to strip away all the hype and the noise to look exclusively at the facts and the data. So whether you're a seasoned trader or you're just trying to make sense of the news, let's get a really grounded understanding of exactly what's happening right now.
Because, it's the big question on everyone's mind right now. Is the crypto boom over? Look, over the last few weeks, if you've opened up a financial app or checked any market trackers, you've likely been greeted by a complete sea of red. There's this immediate, palpable anxiety gripping the market today. It feels super sudden, and for a lot of us, it feels pretty alarming. But to truly figure out if a boom is actually over, we've got to move past that initial emotional reaction to those red charts and really analyze the mechanics of the drop.
Which brings us to Section 1, the recent crypto correction.
Okay, let's dive into this. This downturn is not just some isolated event hitting fringe projects. We're seeing the heaviest foundational assets, like Bitcoin, Ethereum, Solana, and honestly, numerous altcoins, all facing incredibly intense selling pressure. The sheer weight of this widespread decline is literally tipping the scales of investor confidence globally, dragging total market valuations way down. And because this pressure is just so heavy right now, we have to ask the logical next question.
That's Section 2. Why are prices falling?
Well, the downturn is fundamentally rooted in a few cracking pillars of the global economy. We're looking at rising concerns about economic growth, shifting interest rate policies, and of course, geopolitical tensions. When these massive macro factors converge, investors get cautious. And what do? They pull their capital right out of high-risk assets, like cryptocurrencies. This overarching economic uncertainty directly drains demand and drives prices down across the board.
And this brilliantly illustrates the domino effect of panic. It triggers a literal mechanical chain reaction. Step 1, macro fears push prices down. Step 2, spooked short-term investors accelerate their panic selling. Step 3, and this is absolutely crucial, leveraged traders get liquidated in mass. These forced liquidations flood the market with even more sell orders, which violently pushes prices even lower and faster in a remarkably short period. It's basically a vicious cycle.
Moving right along to Section 3, altcoins take a hit.
So, during a flight to safety, market liquidity kind of acts as a shield. Bitcoin, being the most established asset out there, possesses deep liquidity and much stronger market support. Altcoins, however, are essentially skating on thinner ice. When the broader risk appetite just vanishes, funds hemorrhage from these smaller, less liquid projects first. It really exposes their inherent vulnerability when the broader market withdraws its support.
And then you have speculative meme coins. These are driven almost entirely by social sentiment, rather than real utility, so they suffer the absolute most violent shockwaves. Without deep liquidity to cushion the fall, these assets can lose massive percentages of their value in just a matter of weeks when panic sets in. Make no mistake, it is a very swift and very unforgiving environment.
Okay, let's take a breath and zoom out a bit for Section 4, understanding crypto market cycles.
It's so easy to get tunnel vision during a crash, but experienced investors understand that aggressive corrections are basically baked into the DNA of digital assets. A market cycle is simply a historical pattern, where periods of really strong asset growth are inevitably checked by market corrections. Markets just don't go straight up forever, right? It's a completely normal part of the ecosystem.
Looking at the historical market phases mapped out here, bullish growth leads to the exact type of market correction we're analyzing right now. And that correction then gives way to an accumulation phase. For those playing the long game, historical patterns actually indicate that these widespread declines frequently act as resets, creating some pretty significant opportunities for long-term investors. It really just depends on where you deploy your capital.
Now, what's really interesting about this slide is where the smart money goes when the speculative froth clears. They look for attractive entry points focused strictly on core metrics, strong fundamentals, real-world utility, highly active development teams, and clear long-term adoption potential. During a downturn, these specific metrics become the definitive compass for finding truly quality assets. Which leads us into our final part, Section 5, navigating the downturn.
We have to be completely objective here. As the quote says, some projects may never regain their previous highs, while others could disappear entirely. We aren't here to cheerlead either way. Investing in cryptocurrencies remains highly risky, and the potential for total loss in certain assets is a factual, historical reality. You absolutely cannot assume a rising tide will automatically lift every single sunken ship.
Because of that extreme risk, surviving a downturn requires some absolutely essential defensive strategies. We're talking about true diversification, strict risk management to prevent catastrophic exposure, and just relentless, thorough research. You literally cannot rely on hype. You have got to do the homework to understand the underlying fundamentals protecting your investments.
Ultimately, successful investors prioritize long-term, organic growth over short-term price movements. Patience, discipline, and a really clear plan are what separate successful participants from the folks who are driven purely by market emotions. They just don't let themselves react anxiously to those daily ups and downs.
Because for those who manage risk and keep that long-term perspective, the current market environment may be viewed as a period of accumulation rather than fear. I mean, that is an incredibly powerful perspective shift, right? By zooming out, ignoring the short-term noise, and focusing on utility, informed investors can navigate this whole landscape with clear strategy rather than blind anxiety.
So, that leaves us with one really vital question to think about. Are you reacting to the market, or are you planning for its future? Understanding the raw mechanics of a correction is the very first step toward building an informed strategy. Thanks so much for joining me on this Explainer today. Keep digging into the data, stay curious, and I'll see you next time.